This video begins with a simple disclaimer that this video is only for education purpose. Imagine waking up one morning and realizing that some of the biggest banks in the world are collapsing. Families are losing their homes. Major companies are disappearing overnight. Millions of jobs are vanishing, and the entire global financial system is at risk of shutting down. Now imagine all of that happening not in a movie, but in real life. Between 2007 and 2009, the world witnessed one of the worst economic disasters in modern history. A crisis so big that it reshaped banking laws, changed how investors think about risk, forced governments to step in with emergency actions, and created lessons that every new investor must understand. In today's video, we are going to break down what really caused the 2008 financial crisis, how it spread, how it affected everyday people, what role Wall Street played, and what long-term investors can learn from it so we avoid the same mistakes in the future. By the end of this video, you'll understand how something as simple as a house loan turned into a global financial meltdown, and why this one event still influences the stock market today. Welcome to Crypto Brain Power, the channel where we make the stock market simple for beginners. Here we explore the history of global markets, past crashes, powerful financial lessons, and the long-term mindset that helps investors grow steadily over time. Our goal is to break down complex concepts into clear and practical explanations so you can learn confidently, without confusion and without hype. The 2008 financial crisis is often described as the moment when the world's financial engine suddenly stopped working. But to understand how it happened, we need to start with one thing: real estate. In the early 2000s, buying a home in the United States became easier than ever. Banks and lenders, believing that housing prices would never fall, started giving out home loans to almost anyone, even people who had low income, weak credit, or no ability to repay. These risky loans were called subprime mortgages. On the surface, they looked harmless. People were getting homes, banks were earning interest, and housing prices kept climbing year after year. But behind the scenes, something more complicated was happening. Big financial institutions were bundling these risky home loans into large financial products and selling them to investors. These bundles were called mortgage-backed securities. Many investors, including pension funds, insurance companies, and banks, believed these products were safe because rating agencies gave them strong ratings. But in reality, they were filled with extremely risky loans. This was like packaging hundreds of weak houses together and calling the neighborhood strong. As long as housing prices kept rising, the system functioned. But in 2006, something changed. Home prices stopped going up. People with subprime loans could no longer refinance. Monthly payments increased. And many homeowners realized they could not afford their mortgages. When thousands of people began defaulting at the same time, the entire system started shaking. The value of mortgage-backed securities collapsed. Banks holding these products suffered huge losses. And suddenly, the financial world realized something scary. Nobody knew how much risk was actually hidden in the system. By 2008, confidence had completely disappeared. Large U.S. institutions such as Bear Stearns, Lehman Brothers, and Washington Mutual collapsed. Lehman Brothers, one of the oldest U.S. investment banks, filed for bankruptcy. This event sent shockwaves across global markets. Stock prices fell sharply. Credit markets froze. The S&P 500 dropped more than 50% from its peak. Even strong companies like Apple and Amazon saw their stock prices fall simply because investors were terrified. Ordinary people felt the crisis in the form of job losses, falling home values, and shrinking retirement accounts. Platforms like Fidelity, Robinhood, and Charles Schwab did not offer the easy investing experience they offer today. Many beginners panicked and sold their investments at the worst possible time, locking in heavy losses. The U.S. government and Federal Reserve had to act quickly. Interest rates were cut to near zero, emergency lending programs were created, and banks received support so the financial system would not collapse completely. These actions helped restore stability, but it took years for the economy to recover. The crisis became a turning point in U.S. financial history. New regulations were introduced to prevent banks from taking excessive risks. Mortgage lending standards became stricter. And investors learned a valuable lesson. When something in the market seems too good or too easy, it usually carries hidden risks. The 2008 crisis reveals several important lessons for beginners. The first lesson is that leverage and debt can be dangerous. Banks used borrowed money to buy risky securities, hoping for bigger profits. When things went wrong, their losses multiplied. The second lesson is to avoid chasing fast returns. Many homeowners took loans they couldn't afford because they believed house prices would always go up. Many investors bought mortgage products without understanding the risks because everyone else was buying them. The third lesson is that markets move in cycles. Even strong companies can experience temporary declines. Apple, Amazon, and other successful businesses recovered and grew far beyond their pre-crisis levels. But only long-term investors benefited. Those who sold out of fear missed the recovery. For new investors using apps like Robinhood or Charles Schwab, the crisis shows why it is important to understand what you are investing in. Blind confidence can be just as dangerous as fear. Instead of trying to predict short-term market movements, focus on learning financial basics, understanding risks, diversifying your portfolio, and staying patient during downturns. Stock market crashes are painful, but historically, markets have recovered and grown over time. Long-term discipline is often more powerful than short-term predictions. As we reach the end of this video, remember that the 2008 financial crisis was not just a banking disaster. It was a lesson in human behavior, risk management, and the importance of responsible investing. It reminds us that even the strongest financial systems are vulnerable when greed and poor decisions accumulate over time. By understanding what happened, you can become a smarter and more cautious investor. Thank you for watching. If you found this explanation helpful, subscribe for more educational videos on the stock market and financial history. Educational purpose only, not financial advice.